This is topic 7, trusts, lesson 7a, trusts basics. Okay guys, so this is probably the first exposure to trusts for the majority of the class. It's always a topic that interests students, and if you can grasp the basic principles, you can do really well. It's also a topic which comes up fairly regularly in the ITC. Trusts have received a lot of bad press both locally and abroad in recent times, mainly for their use as a tax avoidance or evasion vehicle, which is probably why everyone seems to find them so interesting. So if we look at the definition of a trust is a legal relationship, a contract, created during the lifetime or upon death of the founder of that contract. What happens in a trust is that the founder places assets under the control of someone called a trustee for the benefit of the beneficiaries of the trust, whoever those people may be. It's fairly common for parents to place assets under the control of a trust for the benefit of their families. I'm sure you've all heard of the term trust fund kid. So in terms of the primary uses for trusts are commonly used in estate planning as a means to avoid estate duty when you pass away. Secondly, trusts can limit your tax liability by diverting income streams from your hands to others, and we'll deal with that when we also look at section 7. And lastly, it's very common that minor children are provided for in terms of trusts upon the death of their parents. So in terms of administration, the founder of a trust initiates the legal process to form the actual trust. The founder then nominates trustees and beneficiaries in terms of their trust deed. Now the founder can transfer assets to the trust in one of two ways. They can sell those assets to the trust, or they can donate them. In both cases, there are going to be CGT consequences. We just need to be aware that where the assets are donated, which is the more common form of transferring assets to the trust, we need to consider donations tax as well. So once those assets are transferred to the trusts, they fall under the curatorship of the trustees. And you can think of the trustees as similar to the board of directors in a company. They are charged with making those decisions, and they control those assets for the benefit of those beneficiaries. Income is then earned on those trust assets, and this income is either retained or it's paid out to the beneficiaries. The beneficiaries, you can see, are similar to the company shareholders. This topic serves to answer the question, where is the income earned on trust assets taxed? Is it taxed in the donor's hands, the beneficiary's hands, or the trust's hands? It's important that in each year of assessment, every single rand of income earned in the trust gets taxed somewhere. So a trust is included in the definition of person, which means that it's a taxpayer in its own right. What's important to note there is a taxpayer is a person, not a natural person. Therefore, none of the natural person exemptions, such as 10(1)(I), will apply to that trust. Then a trust year end is always the 28th of February, no matter when it was founded. Trusts basically form into two broad categories. The first category is an inter vivos trust. That's one that's created during the lifetime of a founder, and it's normally created to avoid estate duty tax down the line. The second category is called a testamentary trust. That's created upon the death of the founder, normally in terms of a last will and testament. And the primary use for a testamentary trust is to create a mechanism to provide for a family after the death of a taxpayer. So those are the two broad categories. Then there are two broad trust types, a special trust or an ordinary trust. So a special trust is one that's created for someone who is mentally ill or disabled, or it's a testamentary trust, so important testamentary trust, so it's created in terms of a will for the relatives of the taxpayer, where that youngest taxpayer is younger than the age of 18 years old. Now, special trusts are taxed at the sliding scale applicable to natural persons. That's the sliding scale that goes from 18 right up to 45%. And for CGT purposes, there's a 40% inclusion rate. If you qualify as a special trust, the annual exemption, primary residence exclusion, and personal use assets exclusions are applicable there. No other, remember, it's still no other natural person exemptions can apply. The second trust type there is an ordinary trust. So an ordinary trust is any trust that's not a special trust. These are taxed at a flat rate of 45%, which is effectively the maximum marginal tax rate for individuals. And the CGT inclusion is an 80% inclusion, okay, equivalent to the company inclusion, rather than the 40% inclusion that special trusts benefit from. In terms of the nature of trust income, trusts can own any number of assets, and therefore they can realize any number or types of income. They can realize dividends, interest, rent, trading income, etc. Now, one of the important principles in trusts is this conduit pipe principle, which basically means that income retains its identity until it reaches the party in whose hands it's going to be taxed in. So I've given you an example then. I've said if trust income is dividends and that dividend is paid out to the beneficiary, that beneficiary is deemed to have been receiving dividends in their hands. So the conduit pipe principle effectively means that income flows through the trust straight into the hands of the beneficiaries, and the nature of that income doesn't change. What's important to note there is that this conduit pipe principle only really applies if that income is paid out in the year of assessment it accrued to the trust. So if dividends are received this year and they are paid to beneficiaries this year, there will be dividends in the hands of those beneficiaries. But if they're only paid out next year, they will no longer be dividends in the hands of those beneficiaries. So you retain its nature as long as it's paid out in that same year of assessment. All distributions to beneficiaries are deemed to consist pro rata out of all the different income streams from the trust, unless the trust deed specifies otherwise. So what I mean by that is that if the trust earns 50 rands worth of dividends and 50 rands worth of interest, and an amount of 10 rand is paid out to a beneficiary, the pro rata rule will mean that half of that 10 rand is paid out as a dividend and half of that is paid out as interest. In terms of 10.2b, income can either be paid out as an annuity or as a straight payment. Remember, an annuity is a continuous set of payments. If it's paid out as an annuity, the dividend of interest portion of that trust annuity will not qualify for the 10.1h or k exemptions, but it will qualify for the 10.1i exemptions. So in terms of annuities, only the interest portion is deductible in the taxpayer's hands. So if you're thinking about tax planning, you really don't want to pay out dividends in the form of an annuity because you don't get the benefit of that 10.1k exemption. So what we've said with the trust is that in each year, every single rand of income needs to be taxed somewhere. So what we're saying is that every year, every income is taxed. Every rand of income is taxed. So if there are subsequent distributions of retained amounts, they are not taxed in the hands of the beneficiary unless they're paid out as annuity. And the reason for that is that they have already been taxed when they were earned.